For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001? Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. Do you wish he did?
That's true.
In the near term, you have panics, and the panics cause risk off events. People panic because inflation is really high, and so they sell the inflation hedge. Tell me that again. For example, if you'd asked the same question to Jeff Bezos in 2003 and said, you just had an 80% loss in Amazon. Do you ever wish you sold Amazon in the year 2001? Jeff Bezos could have sold Amazon in the year 2000 and avoided a 95% loss. Do you wish he did?
That's true.
But you see how foolish that is? Right? For example, Mark Zuckerberg, could have also sold Facebook, just before or just after the IPO and avoided a 50% loss. In fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. I think that trying to time the market is a trader mentality, but if you look at all the richest people in the world, they're not traders.
They're hodlers.
Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, right? Larry Page, name the person that traded their way to that situation. You can't really do it. Trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that 80% of your returns come in 1% of the days. So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all. So the way this is going to work is it's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank, and you'll be angry. I think the trading mentality is just really an awful mentality for anyone that, if you're not running proprietary algorithms on high-speed computers, I get it if you're a high-speed computer trader and you're slicing a tenth of a penny 1 billion times an hour. I get that kind of trading. But for 98% of the population, people don't have any proprietary edge to trade. I think that when you're looking at modeling this, you have to be aware of time frames. For example, a lot of people, they want to read a headline and then they want the price of the asset to move the way they want it to move immediately or the very next day. But in fact, there are very long time delays in these things, 6 months, a year, 2 years, 3 years. So I think that, as I pointed out, if you look at the 2-year, the 4-year, the 6-year time frame, Bitcoin is acting very rationally per inflation. But if you look at very short time frames like 6 weeks, you may sometimes get the opposite of the expected effect in the near term, because you've got other drivers. You have traders that have large pools of capital that are trading with a different model that are dominating the market in the near term. So I think that if you're going to invest in the asset, you have to have a clear idea. Are you a trader or are you an investor? If you're an investor, you have to have a 4-year time frame. And then you can only start to make conclusions after you've waited a couple of years. If you're a trader can make conclusions faster. You just look at the correlation. You say, well, NASDAQ traded down 2% today. Did Bitcoin trade down 2% or 4% or 1%? And you're building these back-tested correlated models. And I suppose that works fine. But again, I just think that they're just not intellectually defensible over the long term. For example, the Titanic hit an iceberg. Everybody ran to the deck. Okay. The Titanic sailed into the sunshine and it's a beautiful sunny day, 75 degrees. Everybody came to the deck. Okay, so you've got a statistical model. Everybody runs to the deck. You say, oh, the sun must be shining. It's a great day. Or you built your model and you say, oh, everybody ran to the deck. We must have just hit an iceberg. But you see, at the end of the day, it does matter whether or not you hit the iceberg or not, or whether the sun is shining. And the statistical model won't tell you the difference between the one or the other. Both of them have a lot of people standing on the deck of the ship, right? And so I just think you got to think more fundamentally about these things. I mean, not too many people are thinking about the fundamentals, at least in the near term. I joked on Twitter, people with less knowledge and more money than you set the price in the market. Over time, they will get the knowledge, you will get the money, right? Over time, what really matters is the underlying fundamentals, right? And in the near term, you have panics. And the panics cause like risk off events. People panic because inflation is really high. And so they sell the inflation hedge. Tell me that again. Inflation is really high. The government can't get it under control. So there's a panic. So people sell the inflation hedge. And then the journalists and the modelers say, well, look, we've run a statistical model for the past week, and it shows that when inflation is high, people sell Bitcoin. So it's not an inflation hedge. Well, if you run the model over 2 years and you look at it since COVID, you can see it's up 229%. And it's pretty clear that gold is not an inflation hedge, and silver is not an inflation hedge, and stocks are not an inflation hedge, right? And bonds are not an inflation hedge, and currency is not an inflation hedge. That's pretty obvious if you look at it over 2 years. But if you shorten your time horizon to 2 weeks, you can come to the opposite conclusion. But in my opinion, it's pretty foolish to come to that conclusion. But that's the market, right? I mean, there's going to be someone that's going to take the other side of the trade, and they can be right in the near term, and they'll be hideously wrong in the long term. And you can't be right in the long term and still be right every day in the near term. Right? Like Jeff Bezos had to look stupid 6 times in a row in order to be the richest man in the world. And so the question is, do you want to be right in a decade, or do you want to be right tomorrow? You choose.
Apart from the great potential that Bitcoin offers, how much does Michael think the price patterns are controlled by smart money to shake out retail investors?
I think there's a lot of randomness there, but the truth is I don't have any particular opinions that I'd like to share about the near-term price patterns. I'm not a trader. What I think is eventually one day you'll wake up and some country will buy $20 billion of Bitcoin, and it'll jump by a factor of 3. And that'll be the thing that's going to drive the price long term is going to be intelligent regulation, as the SEC, the FDIC, Treasury, as FASB, as they issue guidelines, as big institutional investors and big banks get into the space, as countries get into space. I think that'll drive the price up. And I think in the near term, trying to guess what the price is going to be is a losing proposition. So I just don't think it's a good idea to even try.